This presentation is going to look into the contribution of auditing to the UK economy. We hope you enjoy our take on the matter. What is auditing? External auditing is an official inspection of an organisation's accounts, typically by an independent body. It aims to determine if they are accurate, fairly presented, and comply with generally accepted accounting principles. Internal auditing is a frequent audit conducted by a firm's own accountant aimed at correcting lapses before they are discovered during an external audit. When an auditor examines a company's accounts and statements, they provide a report for their opinion on whether the information presented by the company is correct. There are three main outcomes from the auditors. These are qualified, unqualified, and unqualified within the explanatory paragraph. Qualified opinion is an opinion given by a professional auditor which states that the financial statements and information provided by the organisation is limited in scope and has not complied with the generally accepted accounting principles. If the report is given a qualified opinion, it is fairly presented on the condition that an element of audit material has been restricted or the accounting standards were not followed. However, it could be adverse if the financial statements are deemed to be misrepresented or misstated. Furthermore, it could be disclaimed if the auditor is unable to form an opinion or if they are not independent. Another outcome is an unqualified opinion. This is the opinion given by the auditor when the financial statements and the information provided is fairly and appropriately presented and comply with the generally accepted accounting principles. This is the most common type of auditor's report. Finally, there is an unqualified opinion with an explanatory paragraph. This is essentially an unqualified opinion. However, the auditor believes it is necessary to provide additional information about the audit or the financial statements. The economic view. We're going to take an economic view of the impact of auditing for UK. Most of the analysis lies with aggregate demand and how the Keynesian macroeconomic equilibrium shows how and why it shifts. The movements of aggregate demand along the aggregate supply curve arise from changes in its components, which are consumer expenditure, investment, government expenditure, exports, and imports. Most importantly, auditing uncovers fraud within a business, as well as discouraging it and making it less profitable due to increased measures needed to hide it. It helps companies realise that the potential of their company and helps investors see this potential. Alternatively, it could highlight any weaknesses in business models. It gives credibility and reliability, which, similar to above, audited accounts are more reliable, therefore will be seen as safer for investors, encouraging them to invest over a similar company that has not been audited. Aggregate demand analysis. Competition is kept fair, stimulating competition, and therefore increase levels of productivity as firms aim to reduce their average costs. This will decrease the price of goods and services whilst increasing profits, resulting in high consumer expenditure, investment, government expenditure, and potential increased net exports due to competitive pricing and a very large overall shift outwards of aggregate demand. Investment could be stimulated by the firms and those willing to invest in them. This will create high levels of growth, increasing GDP in the process. These companies which benefit from their weakness being unearthed will be able to see greater future growth from their improved business models. Reliability and credibility means that a company's accounts can be trusted to a great degree of certainty. Therefore, investors will see this as a less risky investment in comparison to an unaudited firm. As they know exactly what they are investing in, this will give the firms a greater supply of cash in which they could invest, and subsequently increase aggregate demand. However, some investors may be very risk adverse and only invest in firms based solely on expected return. There are further benefits of auditing. There are currently around 500,000 chartered accountants in the UK. Meanwhile, the four largest accountancy firms, here on the Big Four, employ a total of almost 900,000. Directors not directly involved with day-to-day accounting can be provided with assurance that records kept are accurate. They are using accurate figure in their running of the business. Shareholders are assured that the company is run as portrayed by the accounts, and if not, changes are likely to be made. The employment from these jobs means that 900,000 people employed in the Big Four are able to contribute to the economy by having more money and therefore spending more, increasing the aggregate demand. Directors will be able to make better informed decisions on how to run the company. This should result in higher levels of productivity as they would have more accurate data in regards to inefficient departments, which they could alter to become more efficient. Any training they would then do could increase employee wages due to a more skilled workforce, leading to increase in consumer expenditure and therefore aggregate demand. And it would act as a source of investment, increasing AD further. If the shareholders are happy with the business, other potential investors are more likely to buy shares in that company. It also ensures that their investments are more safe, resulting in no negative levels of investment.
There are disadvantages of auditing too, and these include outcomes never being certain, the fact that the report doesn't take into account the productivities and skills of employees, and that bad auditing discourages investment. The reason why auditing can never be certain is that an audit is a test for a certain part of the year and not throughout. Furthermore, audit evidence is persuasive, not conclusive. Employees of the firms will try and persuade the auditor's accounts are correct. As a result, collusion and misrepresentation could occur, restricting the auditor from uncovering any present fraud. The auditing does not take into account the productivity and skills of employees. Employees may be less skilled / productive than necessary, so business models will not actually work. An auditor may uncover efficiency but not be able to tell why, leading to incorrect changes. In addition, low-skilled workers and incorrect changes from uncovered inefficiencies may lead to greater loss of profit. Subsequently, investment by that firm is unlikely to be very low, as they have less money to spend. However, if they do invest in training for their low-skilled workers, this loss could be cancelled out. Bad auditing also discourages investment. If a company's audited accounts are inaccurate, this will lead to lower confidence from potential investors, and may ultimately lead to potential investors deciding to invest elsewhere. In the long run, this would lead to less capital in the firm, resulting in lower growth and possibly a reduction in employment. This could lead to a reduction in AD as a result of lower consumer expenditure. The AD analysis of these is, as a consequence of outcomes never being certain, the AD could shift inwards due to exaggerated accounts, meaning there is less investment than the accounts imply there should be. However, due to inaccurate profits, the government could raise more money from corporation tax, in which they could increase government expenditure, negating the inward shift, and as a result, in the long run, the company in which the accounts are inaccurate for is likely to lose a larger amount of money than they allegedly gained before, decreasing investment, consumer expenditure, and government expenditure, largely shifting AD inwards. Auditing is also costly and time-consuming. Meetings and stock takes take time and money, and with the average fee risen 8.8% in the year ending 31st December 2015 from previous year, its costs are only on the rise. Becoming more costly and time-consuming will make it more difficult for the smaller firms to get audited. For the firms involved in this process, this will lower profits as it's yet another expense for the company. This is likely to result in a lower level of investment by the firm and less corporation tax being paid, lowering government expenditure. However, this depends on what level of profit is received by the auditing firm in the first place. The auditors are less likely to invest due to their product being a service and requiring no manufacturer. They will pay an increased level of corporation tax. As smaller firms find it more difficult to become audited, they become less competitive, reducing overall competition within the economy and leading to firms not being as efficient as they need to be. As a result, higher costs will be sent to the consumers. The oligopolistic competition that this market shows, historically this market industry consists of a big eight. However, through mergers, the big eight have been halved to four. This indicates how competitive this environment is. Small firms can't compete with an oligopolistic market structure that exists today. This is due to low costs that arise due to economies of scale. Moreover, their prices also don't fluctuate above a competitive market rate. As a result, in 2015, 304 new auditing firms closed due to this market makeup. Furthermore, 99% of audits in the FTSE 100 and 96% of audits in the FTSE 250 are done by top 4 firms. This has a massive negative impact on the UK, as it suppresses startups in this industry and leads to higher costs for the consumer. As shown in the slide, this is the Sweezy's kink demand curve. An oligopolistic competition leads to price rigidity, shown by X. This is shown by Sweezy's kink demand curve. When a firm raises its price, consumers will switch loyalties to other companies in the oligopoly. As the price elasticity is elastic with price rises, this price increase will lead to overall profit reductions, as a reduction in demand is not proportionate to cover the increase in price. If the firm were also to attempt to lower its price, the inelastic nature of the demand for their product will lead to a lower revenue. This is because other firms will lower their prices too to mimic the change, and so as not to be outcompeted. Subsequently, the increase in demand will be less than the decrease in price, lowering overall profits again. This price stagnation stifles competition, leading to oligopolistic firms having no incentive to lower their price. Resultantly, they do not strive to be more efficient, invest, and lower their prices. This results in lower growth of the firm in the long run, which will lead to a reduction in government tax revenue and consequently government expenditure. On the other hand, as they are big companies with very high profits, they have a duty and the ability to have great corporate social responsibility.
This includes benefits to local business and environmental influences. For example, Deloitte have great schemes within corporate social responsibility, and as the biggest accountancy firm in the UK, with revenues of $36.8 billion in the year 2016, they have the financial capabilities to have a considerable influence. They focus on identifying the importance of aiding startups and medium-sized companies. An example of this is Propel by Deloitte. Propel provides a real-time accounting and business analytics subscription service, which is designed for startups and medium-sized enterprises. Deloitte has identified that entrepreneurs play a large role in providing jobs and creating wealth, and future businesses will subsequently provide enterprise opportunities. Deloitte have found from their research that by 2025, a £100 billion boost in the UK economy could result from targeted help for early-stage female entrepreneurs. An example of an environmental influence is that KPMG is the first of the Big Four in the UK to report to CDP, an international not-for-profit organisation that provides a global system for measuring, disclosing and managing environmental information. They encourage more environmental reporting, and this partnership indicates how being a big firm allows for collaboration with other big organisations, and as a result, a greater influence and change is often made. As a result of Britain's exit from the EU, the movement of highly skilled auditors to other EU countries will be vastly reduced. This will lead to a further reduction in remittances from those countries. However, it will also lead to those skilled individuals spending their disposable income in Britain. In addition, highly skilled auditors have been migrating to the UK from Europe for years. This will become far more difficult after Brexit. Companies may lose some of their valuable staff, as well as also not having access to future European employees. This will possibly reduce the labour force of the UK, depending on the balance of current and future immigration and migration. The potential abolition of free trade with the European Union will result in higher costs for companies exporting from the UK due to tariffs. London is seen as the financial capital of Europe, with their financial services being exported all over the world. The absence of free trade could result in the audit profession struggling to compete with foreign firms whilst in operation outside of the UK. However, the Big Four operates in over 150 countries worldwide. In addition, there is a likelihood that trade agreements could be made in other countries, possibly making it more profitable to conduct business there. As a result of costs of production increase, the AS curve will shift inwards. This is due to cost of production being one of its components.
This will drive cost pull inflation as price level increases while growth decreases. However, the increased advantage in other countries could counter the increase in costs of production and hence negate the inward shift of AS. To surmise, the most significant advantage for the UK of auditing is the prevention of fraud, whilst the biggest disadvantage is the opportunity cost of the money and time required to produce the substantial and detailed audit reports. Other notable factors include the presence of an oligopolistic environment and the exit of Britain from the European Union. The future for UK auditing firms is unclear due to a changing and unpredictable global environment. We predict that the auditing profession's contribution to the UK economy will increase. The inevitable growth of the UK and global economies will drive the enlargement of the auditing profession, as there will be more demand for audits, as it is also a legal requirement. Furthermore, the oligopolistic nature of the market will intensify with fewer and fewer small to medium-sized firms in existence, and with the absence of new regulation, we predict that there could be as few as 10 or less firms in the market in the long distance future. Thank you for watching, and we leave you with this question.